Hi, good evening, everyone. Just give me a moment to share my screen here with you. Hi, evening, everyone. Thank you for taking time to join us on tonight's webinar. My name is Michael. Ming Hui already did a brief intro to myself, so I'm just going to run through briefly with you guys what I do and what my company represents or stands for. Now, I have been dealing in derivatives for the good part of the last 30 years or so in various roles with banks and various brokers as well. So I spent most of my adult life dealing in derivatives, and I got to say that I'm still learning new things every day. So it's with that hope that I hope I can share some of my experience and thoughts with you tonight, specifically on the topic of the geopolitical tensions impact on the energy market. Now, I would like to thank CME and Phillip Nova for providing me this opportunity and platform to speak with you guys tonight. So without further ado, let me just go on to the first slide of tonight. Now, Mingwei already did a quick intro, but what I want to share with you is my company, Inspirante Trading Solution, or ITS. I'm a current trader with SLC, and ITS is really the offspring of SLC, where we got a team of professional traders going around conducting talks, webinar, and trading workshops, as well as a mentorship program. Now, it is our hope to share, through sharing of our experience, that we will be able to invigorate the local trading scene or community per se. So do check us out on our website at the end of this webinar. I'll be showing you a link for you to look up for further information on our company. All right. Now, on top of going around training, we are also regular speakers. I mean, regular publisher and author for a few newsletter with various exchanges. Like this one you have seen on the screen is called Fresh from Trading Room. It's a collaboration of ITS and CME. It's a bi-weekly newsletter wherein it contains some of our newest trading thoughts, opinions, and some actionable trading ideas at the end of the publication itself. So the link is provided on the slide there. If you can see, it's a free publication. So I urge you to take a look at it. All right, just have a sense of what we are thinking or in the general way of the market. Yeah. On top of that, we are also contributing regularly to TradingView. It is, although of a more technical flavor kind of, but usually the starting point is some fundamental factors is driving us to a certain way of or feeling about the market, and coupled with a appropriate technical analysis, we will actually present those ideas in TradingView. So you can look at those as well. The links provided in the slides there. Now, okay, as with everything, futures trading is a really risky business. I'm sure most of you are aware. So, well, long story short, just do your homework. Speak to your professional trading advisor or your brokers before engaging on the trades. Yeah. Okay, now for tonight, I would like to start with an overview of the energy market dynamics. I'm going to talk briefly, specifically with focus on the impact of the current Ukraine-Russia conflict and its impact on the supply chain, and follow that with the alternative energy strategy that's being implemented and the kind of implementation timeline for those strategies. And finally, on the last part of that, I'll be talking about sharing with you my opinion and what I think we should be or would be looking at in the near to midterm future, right? And then from there, I establish a basis of a relevant time frame, which is really my way of saying that it's my preferred trading time frame given the current market condition. I'll share with you how I come to the conclusion for that particular time frame. Yeah. Now, and following that, we're going to do a quick historical price review of a few products, specifically the WTI crude oil futures and the Henry Hub natural gas oil futures, natural gas futures and options. Now, these two are the most widely traded energy futures contract in the world. All right, I think the Henry Hub natural gas accounts for about 86% of all natural gas futures traded in the world, and the WTI is, I do not have the percentage, but it's trading with a daily volume of well over 1 million. So you can imagine how active and liquid it is. Yeah. I will speak a bit more about the specs in a moment. Now, then before I jump on to share with you how I'll be approaching trading this market, I would just like to give you a quick word and my take on risk management, which is obviously a very important part of any trader's venture. Okay, and finally, I will talk about how I am currently trading this and give you some perspective of how I came up with the system and what am I looking at, basically how I will apply those ideas into an actual trading, actionable trading decision. Yep. So following that, we will have the Q&A. I hope to leave some time there, and then we can ask your question then. Yep. So okay, without further ado, let's start with the overview of the current tension that we have impacting the markets. All right, when we talk about the current crisis impact on the global energy landscape, right? We need to have a sense of the weight of Russia in the global energy play. Okay, now basically Russia is like the second largest producer of natural gas and the third largest producer of crude oil globally. Taking Russia out of the equation obviously is going to cause a lot of stress to the supply side of the equation. And coupled with the fact that Europe's long and strong dependence on Russian supplied energy sources, it makes switching and sourcing especially tricky. I mean, that's the main reason behind the spike in the recent run-up following the crisis as well, right? And then we'll talk about the the kind of sanctions and the outcome that's been achieved so far. Now, I'll be focused solely on energy, particularly natural gas and crude oil. Bear in mind that Russia is also a crucial or key producer of a lot of other industrial commodity that is vital to the production scene. All right, so we're just talking specifically on the energy part of the space. Okay, now against the backdrop of a demand spike that was in a post-COVID world, okay, and couple that with a lagging capital investment scene that we have been for the last 2 years or so since the breakout of COVID, right? Now the supply of energy or supply of commodity in the general sense have been actually trying, but to a difficult extent, all right, to a limited extent, been trying to catch up with the expected pent-up demand in the post-COVID world. So that in and of itself has already produced a lot of stress on the global supply landscape, or not just solely on energy itself. Okay, now currently the energy consumption worldwide, right, is still largely dependent on fossil fuels, so we don't really have a lot of viable alternatives. Now, despite the decarbonization initiative that is taking on and the ESG initiative that's been in all the vogue, we are not at a stage where it's replaceable. So all in all, in the mid to short term, I mean the short to mid term, at the very least, we have no way of getting out of this consumption habit. So therein lies the problem now. You got a major supplier being cut off because of this crisis, and naturally this gap would have to be somewhat filled from the other suppliers. Well, of course, that's depending on the amount of supply that's available, which largely is a problem right now because we're facing a low inventory, a lack of capital investment in the last 2 years. So we're talking about production capacity and basically inventory, which could not cope with this gap that's been void by Russia's absence. Okay, so naturally that and what it stands for have driven the energy market prices to unprecedented high in a sense, right? So now if you look at the amount of Russia's export in crude oil, just a quick look at it, a big part of it is going to Europe and Asia, as well as natural gas, which almost 3/4 is entirely going to Europe. Now, this high dependency of Europe on Russia's natural gas especially is making it very difficult to switch, because traditionally natural gas is pipeline distributed, and the vast pipeline network in the Europe continent to Russia is what's hinging on the supply side of the equation. Though that's a little bit difficult to overcome. Now, although there's some possible solution, which I will discuss in a moment. It is not actually a very economical way of replacing the previous supply of natural gas per se. All right. So take a quick look at what's been done so far in the aftermath of this crisis and the cut-off of Russia in the supply side of the equation. Now, there have been release of reserve supplies from those strategic reserve supplies, right? Basically, the EIA union companies, union nations, basically have pledged so far twice to release somewhere in the ballpark of 180 million barrels as a emergency relief to try to elevate the price and also to signal to the market that it will be standing behind in any kind of a supply crunch, trying to basically assert the market of any like such price pressure. Now, obviously, that is limited to how much reserve they have. It's not indefinite, obviously. Now, for the short term, it may ease the pain a little bit, but this is hardly a long-term solution. I mean, obviously, if Russia come back to the scene, then we are all good. But that's provided if it does come to a point where it will be a player again in the energy market. So, but then we do not know when. Okay, so these are the various strategies that have been implemented so far. Now, that includes now the number one problem that has been highlighted in this crisis, right, is really that of energy security. Nations are beginning to realize the fragility of the supply chain, not just in energy itself. Meaning, you see, if you got a knot or a chain down, like in this case, where Russia out the picture, you are basically hanging in the air. You don't have a lot of viable solutions since you became so highly dependent, for Europe's case, on Russia energy, for example, right? So now, one of the objective or one of the push right now, obviously, is to while looking for alternate and viable energy sourcing, they are looking for ways to overcome their energy consumption pattern, perhaps even the revival of coal power plant, or some of the more aged coal power plant that's still in operation, and as well as looking at LNG imports. LNG stands for liquefied natural gas, which is the liquefied form of natural gas. Now, the thing about LNG is natural gas in essence, liquefied through process, and because of this process to enable it to ship across continent, it is a lot more expensive in terms of the total overall cost of natural gas. So at the moment, it is not an economical solution or substitution for the natural gas shortage. All right, but then being where it is right now, you are seeing a lot more imports from the likes of US, which has surplus production in natural gas space, and that's trying to fill up the shortfall somewhat, although not in its entirety. Okay, now all these are short-term options that the nations have to deal with the current crisis. In the mid to longer term, the options, obviously, we talk about switching the focus of the energy policy, like for example, have more diversification of supply source. Of course, that will come at a price, obviously, and that's really to increase the reliability and the security of your energy supply. I mean, given what we have spoken before, right? Then one of the other initiatives that's been kicked off is the expansion into the renewables, right? The green energy, so to speak. We might actually see an acceleration of the timeline for its implementation. But even if we do see acceleration of that implementation, it's probably going to take at least another 5-10 years minimally for it to make a major impact into the energy space per se, right? So the other longer term solution is probably, like I said, examining the consumption habits, focusing on greater energy efficiency kind of consumption patterns. And one last but not least, a less popular kind of option is really nuclear energy, which is probably still on the table, although not necessarily a popular one. Okay, so these are some of the alternative and solutions that the nations been facing with shortage have come up with. That is more or less, as you can see or sense, that this is like a stopgap kind of solution, because you really don't have a comprehensive way to overcome that much of a shortage overnight. Okay, this is a production gap that's not easily can be easily overcome with a stopgap kind of solution, right? So based on that, and given the current micro backdrop, right, we're looking at the lagging production capacity post-COVID because of the reluctance to invest during the COVID period. Production capacity generally been on the low side, as far as inventory level. I mean, since the things is looking up in the sense of post-COVID, with a lot of pent-up demand expected and a lot of resumption to normal economic activity level, there has been a lot of drawdowns on resources, right? So naturally, with the production capacity lagging and a drawdown on the inventory, we have a general low inventory level across the spectrum of commodities, which is why one of the reasons why most of the commodities are at multiple year highs actually. Now, like we discussed before, implementation time frame for the various alternatives is going to take a long time. It's not going to happen overnight, certainly not even over the year. Although we talk about the various commitment from the Europe side, especially as to how they are going to be switching out of Russian energy. That's still going to take some time, and not necessarily all are in agreement because of, like I said, the dependence, the infrastructure dependence on Russian energy is just too critical a part of the Europe economy, right? Now, the thing about energy consumption is habits is inelastic, at least in the short midterm. All right, people have to use people who are using air conditions, using like a heater, for example, they will resume to using that. I mean, they can try to cut back a little, but do not expect them to be totally stop doing that for the foreseeable futures. All right, now on the fiscal side, that's what we are considering, and then think about where we are in the economy right now. The Fed's looking to tighten, right? That we are looking at the end of the easy money era because of inflationary concern. And as far as we know, the Feds are probably going to be staying on their warpath at least till the end of 2022. Given the projection of where we are right now, it's probably going to raise it up above 2%. And continue to high in June and July, which is almost a certainty right now, given the language from last night's minutes. So in that kind of tightening phase of the economy, coupled with high inflation, and then you got a production bottleneck kind of. So what will likely happen here? Well, in my opinion, basically, right, given this backdrop, right, the number one thing I think that's likely to persist is that of volatility. Now, there's no saying when all this is going to end, where we're going to have a sense of semblance of normalcy. Okay, when hopefully it will be over sooner than later, especially in the Russia-Ukraine crisis. I mean, I hope they could settle into something and then end this peacefully and soon. That would be better for everyone, actually, especially the Ukrainians. Now, the thing is, we don't know when it's going to happen, despite all this is going in underneath the market. So I think the volatility is the number one thing in my mind that's probably going to be elevated in the near foreseeable future. All right. As far as prices are concerned, especially in energy price, I do believe that it should continue to stay lofty in the near midterm. I mean, if nothing else, like I said, the supply bottleneck is simply not something that can be overcome in the near term, and people are still going to use and need what they need. All right, so until sufficient time had passed for this alternative to be able to kick in, you are not going to see a lot of easing up on at least the demand side. Okay, given what we have seen in the weather pattern right now, right? You got heat wave in various parts of Asia, and possibly summer coming into the northern hemisphere, which will also affect the consumption pattern and level of the crude oil, for example. Things like that, okay, will probably mean that the the limited supplies is going to keep the prices at the elevated level. Okay, by elevated level, I'm probably thinking about the crude above, like staying above $100, for example, right? So now in the long term, though, given sufficient time, I believe that demand will likely to plateau. People will get used to the idea of trying to come to terms with let's say if the energy price was this steep, they will have to try to come to terms with coming up with alternative or trade-offs from what they can do. So in that sense, they will try to find a new equivalent if everything else should persist. But at least there will be enough time for the demand side to be adjusting to the new supply reality. Okay. Now the key uncertainty of when this all is happening is about timing. I mean, you hear a lot of people calling for crude to be like over 120 in 6 months' time and whatnot or otherwise. Well, I prefer not to think of the market in the binary sense because it is extremely fluid given the situation right now. So it's kind of hard to pinpoint and with any degree of accuracy as to when this is happening. Therefore, my preferred timing or trading time frame, which I call it the relevant time frame, would be in the short to mid term, since there's a lot of unpredictability as to the longer term price trend per se. And given the volatility which I expect to persist, I think that should offer us a lot of opportunity in the trading in the shorter time frame. All right. Now, quick overview of the crude price history. If you can see, like from just give me a second, the words are a bit small for my eye right now. Sorry. Okay. Now, there are a few major global events, namely that of the Iraq War, for example, in 2003. Then the 2015 U.S. shale oil boom that caused a big drawdown, a pullback in the price, and then finally in 2019, where the COVID hits again, we got another big down move in the crude oil prices just before the turn of 2021, where we actually got some sense that the COVID might be behind us soon, and that actually drove the demand side of the equation and the prices higher, right? So what I want to highlight here is basically crude oil is very much a global commodity. There are a lot of factors at play that affects its price, both on the demand and supply side. There are many factors that can actually drive the price, okay, in a sense, but it has a more global flavor. I mean, it is very, very affected by global events, okay. That in contrast to how natural gas usually behave, okay. Natural gas, because of its nature of distribution, which is usually pipeline, it gives it a very regional kind of focus or flavor. What it means is really like its price, at least on the domestic level, is highly dependent on the domestic consumption and production pattern. Okay, so as you can see in this chart, usually over times, the biggest number one factor that makes a big cause a big move in the natural gas prices is that of demand and supply. Really, in a regular way, due to weather driven kind of a consumption pattern. All right, I will leave you to look at it. All right, and this has caused some seasonality in both products. First one about the WTI crude, obviously. It tends to pick up just before summer, and because of various production demand, driving demands, traveling demands, and whatnot during those summer times, and it picks all the way until just before the end of fall, before it actually comes off again into winter. Obviously, this seasonal factor is only one element that's determining the price, and hardly the only one. But do pay attention and get a sense of what it is when you're trading these products. All right. As for natural gas, we have somewhat similar weather-dependent kind of seasonality. Now, for natural gas, the biggest draw is usually around the winter period, starting from August. Where the inventory will get drawn down as winter nears, and people use a lot of more natural gas for heating purpose and stuff. Yeah, and then it comes off gradually as the winter comes to an end and production slow and the inventory start rebuilding up again. All right, so in that sense, there is a regularity in the way the price behave, at least for the seasonality factor for those products. Okay, one other thing is about the crude oil natural gas ratio. Now, interestingly, is both in a sense interchangeable in terms of energy unit. In fact, there is a term called thermal parity, which says that that's about 6 units of gas is equivalent to 1 barrel of oil per se, thereabout. Okay, what it means is really the convertible equivalent of energy from one to the other to produce a similar kind of output. Okay, but as you can see, it is hardly consistent. Okay, now one of the main reasons was because crude oil and natural gas is very much related in terms of production because of the way they are being buried in the ground. Usually one, you derive one and you get the other as well. And it really depends on the method of obtaining the oil and therefore the gas as well. And there is a way to get one or more of the other. With the advance in fracking technology in the US shale boom, there has been a major shift in the natural gas supply side equation, which is actually what has driven the ratio up to a very high level, all right, during those years. Okay, so just a general sense of a look. I would hardly use this as an indicator of anything, just so that you know. Okay, now then for tonight's contracts that we'll be talking about in the while I'll be sharing how I trade those things. We'll be looking at the NYMEX crude oil futures and option. There are two variants of this crude oil futures. One is what we call the full contract and the micro contracts, which represents 1,000 and 100 barrels of oil respectively underlying. Now, these are effectively the most widely traded crude oil futures contract in the world. All right, you have an average volume of in excess of 1 million every year, every day, average daily volume of over 1 million every day, and I think open interest is in the ballpark of about 2 million these days. Okay, now the micro version is about 1/10 of the full version, obviously, and both contracts trades actively and on NYMEX, and you could take a look at it as well. The options market. Equally liquid as well, which provided the backdrop for doing a lot of other things that we don't normally do with market as only futures. But I urge you to take a look at those when you're checking this out. And coincidentally, the crude oil options are not only for the full size contract. There is actually a micro WTI crude oil options that's going to be listed on the 6th of June. So do take a look at those on the CME website. Those are quick information there. A quick look at the NYMEX Henry Hub natural gas futures. Okay, it represents 10,000 million BTU, which is a unit of measurement, British thermal unit, in case for you guys want to know. All right, for this underlying, as well is like I said, the most actively traded gas futures, natural gas futures in the world, with an average volume of well over 500,000 daily. And it also has a very active option market. All right, there is a micro version of the natural gas futures, coincidentally, which is called the mini. I think it's called a mini. Okay, the mini natural gas futures, which is approximately, not approximately, it's actually exactly 1/4 of that of the full natural gas futures contract. Okay, now we are running short of time, so I'll just be brief on this. Before I go on to the trading part of the next webinar, I would just like to share with you how I see and view risk when I'm trading the market. Now, as traders, we are here to make money, obviously, and my goals primarily is to build wealth, but not just simply to build wealth. I want to build it with some degree of viability, meaning to say I wanted to have some consistency and longevity. Okay, the worry is not that I do not make money today, or that I lose money for the matter today. The concern is that I will not be able to trade tomorrow. In very bluntly, my number one concern is that I do not want to put myself in a position where I would not be able to trade the next day. Okay, as long as I keep trading and doing the small things right, eventually the average, if I have hopefully done everything right, will work in my favor. And that's how I will reliably and consistently build up the wealth part of it, and with some sort of consistency and longevity. So now, to put it in like 3 principles, okay, 3 working guides of how I approach, how I do this. Okay, my number one concern will always be about risk then. All right. Now, before I dive into any trading venture or trading strategy, for example, my number one concern is always about risk, since my consideration is that of preservation of capital, right? Just to ensure that I'll be able to trade the next day. So think about it that way, right? Once you get it covered, right, consistency of profitability basically requires you to do your homework. All right, you have to do it objectively, you have to execute it diligently, and then you have to follow your plan without any prejudice. Okay, now the one of the biggest problem or biggest trouble that I see with new traders is usually there will be a lot of self-doubt. Now, market market does not care about how good your strategy or how good your idea is. Okay, you will be losing money. You could be losing money even when you got the best idea in the world. I mean, your execution or your timing could be wrong. The whole point is like you need to approach this with a business-like kind of consistency. You need to go in with a thought. No, I'm in for this, but if I turn out to be wrong, or the market is proving me wrong in the sense by showing me that I'll be making a loss, be taking a loss, for example, I need to have a certain exit point, for example, right? Going in with an exit point in mind, that would ensure that you will not actually face a catastrophic drawdown, and that you will be able to trade again the next day, and while you're reviewing why the current strategy did not work. Now, after you take care of all this, you finally can talk about taking on more risk as your nest egg or your capital base starts building up. Okay, and then and only then will we talk about taking on more risk per se, right? And talk about superior returns. That usually is the last thing on my consideration. All right. So now tonight I'm going to share with you a multi-indicator trading framework. Specifically, I'm going to use a Heiken Ashi candle, coupled with MACD with multiple time frame confirmation. I do this for the very short to near-term trading, which usually means within the day or within the week kind of thing. I'll show you how. Okay, now the Heiken Ashi, if you guys are familiar with this, otherwise you can check it online. There are plenty of resources out there. Well, it basically is, it looks like a candle bar for those who are using candle bar. Okay, except it's tried on the concept of averaging to basically filter out a lot of noise. Okay, now there are only 4 candles that I really want you to pay attention to, or 4 kinds of candles possible actually. All right, the first one, the first green one over here is called the bull candle, where we see a green body, which is the solid part here, with no lower wick. Okay, the wick is on the upper end here. Okay, basically the top and bottom of the wick represents a high and low, and the opening is actually at the midpoint of the well, obviously if it's going up, it's here, right? So the other green kind of candle, which is a waning bull candle, okay, meaning to say you got a small green body with a long wick. Long wick on both sides is fine actually. If you see a longer wick on the downside, it actually just makes your case stronger. All right, what it signals is basically it's still in an uptrend, but the momentum is probably slowing. This is what the candle is trying to show or trying to predict, okay, or trying to depict here, right? Now versus a red bear candle, the opposite of the bull candle, you see a big red body here with no upside wick and perhaps a long downward wick. This actually happens in a market where it's trending strongly lower. Okay, in contrast to a bull candle, bull Heiken candle, and then finally we got the waning momentum on the bear candle, which is really a lot like the other one, the green one, which is really a long wick with a small body in red, and that basically means while the market is still trending down, the sell momentum is probably beginning to slow. Okay, now if you look at how it's being calculated, you understand what it means actually. In essence, it looks very much like a traditional candlestick chart. Okay, except with the averaging, it takes out a lot of the noise where you see, for example, this is comparing like to like, right? The bottom graph is Heiken Ashi, and the top one is candlestick for the same thing. Now, if you look at this stretch, for example, you see a basically all the bull green candle without low wick here showing clearly a upward trend momentum versus the candle bar here where you see an up down and some indecision, even perhaps over here and here, for example, right? So the idea is actually to help you spot a trend with greater ease by filtering out the noises with the process of averaging. Okay, now this is important because in the short term, when we are trading, what we are trading, the momentum and the trend is really what you have to go on. Okay, and those are your best friends in when you're trading in that kind of time frame. All right. So now MACD basically is just another indicator that basically tries to signal a turn of trend or trend, for example, turn of trend by the crossing of the NACD over the signal line. Now, the literature on this is plentiful on the internet, so I urge you to take a look if you're not familiar with this. Well, I'll go through some simple rules and then run you through some examples as well. Yeah. Okay, now with those tools in mind, I would like to propose this. First of all, we will actually have a trigger for trading decision when there's a MACD crossover. Don't worry about that. I'll show you in the next couple of examples. And then once we observe the MACD crossover, we will look for the formation of a bull or bear candle on the 1 hour chart to confirm that this crossover was indeed valid. And finally, we will confirm this further with the formation of a corresponding bull or bear candle on the 3 hourly chart for the same product that we're trading. Now, the simple rule is to set the stop, okay, at the low or high of the 3 hourly bull or bear candle when you are at the point of entry. Okay, that will basically set your stop loss right at the beginning. All right, then the exit will basically be at the point where the signal reverses itself. That means the MACD crossover again now on the other side since your initiation of the position, and then the confirmation on the 1 and 3 hourly chart again with the bull and bear candles. All right. So now, without further ado, let me just run through some examples of what I mean. All right. Okay, just give me a second because the wording is kind of small on my screen. So I'm just going to go through this here. Okay, this is. Pardon me a second. Okay, right, finally. Right, so this is WTI crude oil futures chart. All right, I took the liberty of running over different time periods just to show you how it works over the various market conditions. Now, obviously, I'm only giving the rudimentary part of this strategy. I will explain to you later and how you can further refine and improve on this. Okay. Now, long story short, let's take a look at our entry. All right. Now, we first observed for MACD crossover, which happened on the 30th of September here at 1300 hours, which is shown by this blue arrow here. Here you cannot see, but basically the MACD line have crossed over, the blue line have crossed over the signal line, the red line, and this is signaling a potential bull crossover with the MACD line crossing above. Okay, now the corresponding part where the 1 hour chart is showing a bullish candle is at this point. Okay, which did not happen until 1600 hours on the 1 hourly chart, which is like another 3 hours later. Okay, as you can see. Now, when we look for it at the equivalent 3 hourly chart for a confirmation, okay, it did not happen. Basically, when this bull candle was formed after the crossover at 1600, the 3 hour chart did not confirm it until 2100 hours, which is right about here. Okay, meaning to say we will only enter at this trade at 2100 hours, for which 2200 hours actually we need to wait for this 3 hourly candle to form and end before the new one will proceed, right? So basically at 2200 hour on the 30th of September, we enter a long buy at 39.19. Okay, now the stop, like I said, okay, once you do the buy, the stop is naturally set at the low of the 3 hourly bar, previous 3 hourly bar, and I actually use a 0.5 buffle to ensure that I do not get triggered by those fake breaks. All right. So basically, my stop is set at 38.50 here for this particular trade, having go long at 39.19. Now, if you look at the next part where I did the exit here, okay, it is when the MACD first crossed over here, the red arrow, where the MACD crossed below the signal line, signaling a potential bearish formation. Then I look for the confirmation on the 1 hour chart, okay, which happens at 1600 hours over here. This actually happened the next day on the 1st of October. All right. So after these two are confirmed, I'll look for the similar confirmation on the 3-hourly chart here. Okay, the bearish candle is formed here, but it only formed at 1800 hours, 2 hours later. Okay, now that means I will only be selling this or exiting this particular trade at 1900 hours at the next opening price of 39.87. Okay, now for this trade itself, I make a profit of 68 cents, which is your entry price of 39.87 minus 39.19. Okay, and at the same time, while I did the exit, I actually went short, because the same idea, if you were actually starting here, you would have gone short based on this trading idea, right? So basically, I took a new short after I exited. So basically, my new short is at 39.87, where I exited my previous long, and at the same time, I set my stop to be the high of the previous 3-hourly Heiken and Ashi candle, all right, which is at 40.58, other giving a slight allowance for prevention of fake breaks, all right? So now you look at the next point here, okay? The entry was on the 1st of October, as we saw in the previous chart, we got a confirmation the 1600 hours here on the MACD, and then the 1 hourly bar at the same time as well. And then finally, we got the confirmation over here at 1800, where we went short one and exit the previous trade at 39.87. All right. With that, we wrote this here until the next crossover of the MACD, as you can see here, where the MACD cross up above the signal line again. Same thing, I'll be looking for the first bearish formation of on the 1 hourly chart, which actually happens at 2300. It's exactly the same time as the MACD crossover on the 2nd of October. All right. So the next thing we look for again is the confirmation on the 3-hourly chart. All right. Now this did not happen until after the weekend. Actually, 2nd of October was on the Friday. We did not actually get a bull confirmation on the 3-hourly chart. Therefore, we did not enter the trade and we did not exit it until the next Monday, which is on the 2nd of October. Which is, my apologies, which happened on next Monday on the 5th of October at 0900 hours. Okay, basically the bull candle on the 3-hourly chart formed, and every other parts of the conditions still remain. All right. So basically, at this point of time, we initiate a long position to exit the previous short, and at the same time re-establish a long position on this basis. Okay. So basically, we got out of our short at 37.53, and we make a nice profit of 234 on this trade itself. At the same time, I went long on this at 37.53, and with my target short, with my target stop at 36.75, which is based on the low of the previous Heiken Ashi candle. All right. So now the next chart here, basically following through the previous trade. Okay. Just give me a second here. Let me make sure I got the right one. Yep, 29.30. Okay, number 4. A second. Okay, my bad. I am looking at a natural gas example now. Okay, like I said, the wordings are kind of small, so I really am straining my eyes to take a look at it. Now, the same condition apply and the same rules apply. Okay, you first look for MACD crossover. We're looking at this more recent example, which happens on the 11th of April. Okay, the first crossover happened here, where the MACD line, when the MACD line crossed over the signal line, okay, at 2000 hours. Then we look for confirmation on the 1 hour HA chart here. Okay, and that confirmation came around 2100 hours here, if you can see. Okay, and it suggested a buy at this point of time. But before we jump in and buy, we obviously need to look for a confirmation on 3-hourly chart, which came in at 2100 hours as well. Okay, so basically at 2100 hours, we were able to enter a long here at 636 6.361. Okay, and then again I set a stop on the basis of the low of the previous Heiken Ashi bar, which is at 6.294 after accounting for some parts of allowance to, like I said, I would always like to take a bit of allowance on this to avoid a fake break. Think of it as business expense to avoid having too much fake stopped up per se, right? So okay, along this new long position in the natural gas, we ride along until the opposite signal comes around, which is when the MACD cross below the signal line here, right? As you can see, this happened on the 12th of April, the next day at 1500 hours. Now from there, we looked at a bear candle confirmation on the 1 hour chart, which happens here at only 2300 hours. It's about 6 hours later actually on the chart. And further, the confirmation on the 3 hourly chart did not come until 0300 the next day, which is really the next morning. All right, so by this time, if you're still awake, you'll be doing, or you have some form of automation that can help you do this, you'll be doing the sell to exit your current long. Okay, and if you have got that at that point of time, you'll be selling out at 6.688, giving you a profit of about 0.327 on the trade. Okay, at the same time that I'm actually establishing a short on this signal as well after I get out of my long, right? So a continuation on the next chart here. Like I said, the sell position at 6.688 on the 13th of April at 0400. If we were there, we stop at 6.818 on the basis of the previous high on the 3 hourly Heiken Ashi chart. All right. So we write this short along here. Okay. Now what is interesting is over here. I like you to see that there was a crossover here, all right, at well, hang on a second, let me just see if this is right. Okay, there was a few moments of crossover that actually did not have confirmation in both the 1 hour and 3 hourly chart, so we did nothing there and then, right? So again, this trading rule is this: once there's a crossover, you must be confirmed by a corresponding bull or candle bar, a bull or bear candle bar in the 1 hourly and 3 hourly chart as well, and then would you only initiate a trade. If you are doing this continuously, that means exiting and establishing a position on the other side, but you only do so with that kind of confirmation. So basically, the exit signal came on the 13th of April 1800, okay, when the MACD crossed over here, okay, right. So basically, the MACD crossed over the signal line again. Now, at this point of time, the 1 hour candle bar only shows the bull candle at the 1800 hours, which coincides with the crossover and the MACD. But the 3 hour bar actually, we have to wait until the close of 1800 on the same day before we have the confirmation. Obviously, we can only do it at the next candle, which is 1900 hours. Okay, and we have to buy exit on this trade at 6.75, leading to a loss on this particular trade of 0.062. Okay, so well, it's not simple bed of roses. There are times where you will be taking a hit, hopefully smaller, and you will be taking profit when it's actually meatier per se. All right, that's the whole point of it. All right. Okay, and then finally, on the same note where we actually went long again on the last setup, okay, we write it all the way until the signal crossover again. For example, at this point, you see here, corresponding over here, you see a MACD cross under the signal line, but we do not have a sell signal here because neither was it confirmed by the 1 hour nor the 3 hour chart here. All right, these are the points that I want to bring up to you. And then we continue left, right, and we cross over again. We do nothing since it's a very bullish signal or basis on a long position. We still continue to ride along, and it has a small cross down here, which does nothing really on the two time zone charts. And then finally, the first signal that matters came here when it crossed down again, and this was confirmed both by the 1 hourly and the 3 hourly chart a bit at different timing. The 1 hourly chart confirmed at 1400 with an MACD crossover at 1200, and finally the 3 hourly chart confirmed at 1500 an hour later. Okay, so basically we'll sell exit on our long trade at 7.778, giving us a profit of 1.028 on this last trade here. So now, gentlemen, with that, I've come to the last of my example. Okay, and I would like to pass this back to Ming Hui. If you guys have any question, you can post it up here. I'll try my best to answer as best as I can. All right, Ming Hui, back to you.
All right, thank you, Michael. We haven't received any questions from our audience yet, so if there's anything you'd like to share, this would be a good time while we wait for the questions to stream in.
Okay, sure. Now, guys, I understand today on this topic, given the time that we have, a lot of things I have to skim over. I try to basically discuss with you and share with you what I deem important, especially on the practical trading perspective. Earlier, I was talking about the system. Okay, this is hardly the finished or complete system per se. Now, on the basis of what we just talked about and what I just shared with you, what you could perhaps do is further refine it. Do not try to make it too complicated. All right, I have back tested this and it works. The only question is choosing a time frame, choosing your entry and exit signal properly, setting your stop loss accordingly on the trade, so that you can, like I said, keep doing this, and hopefully over the long run, doing these things right. And like I said, when the momentum works for you, and you will be actually reaping a far greater long-term average return than what you would suffer in terms of the losses along the way. Okay, so that's that. All right, or you could actually don't take my word for it, run this and do your own back test, your own due diligence. It's also applicable not just in the energy futures space. All right, you can apply this same idea to perhaps other products that you're trading and see if it works. Like I said again, run with a sense of testing it first. Obviously, you have to do your own back testing and stuff like that and see what work best, obviously. All right, and perhaps you can come up with something even better than what we have shared here today.
All right, thank you for that advice, Michael. We have two questions. The first
Sure.
question is, are there any systems to identify and trade supply and demand?
Are there any system to identify trade demand and supply, is it?
Yes.
Okay, now specifically with the energy market, right? It's a global market space. Meaning to say, at any one point of time, there are multiple interests, nations, individuals, companies, and whatnot that at present at play in that market. All right. So, in a sense, the price action probably will give you a hint of what the current demand and supply situation is. That's your number one starting point. Now, on top of that, if you want to talk about fundamental background or backbone of projections or otherwise, right? There are a few very useful websites that actually provide a lot of information like that. Now, for energy market, you can look at the EIA website. They have regular publication on the outlook, on the price forecast, on production, supply, on the production demand part of the market, just giving a general overview and sense of what the current market stands. Now, on top of that, there are also a lot of commercial write-ups. All right, the exchanges themselves publish a lot of good articles on a regular basis, like CME. If you check the website, they have a lot of educational articles, and very regularly they produce newsletter like those that we shared earlier, written by various collaborative partners for their view in the market. So those are a very good starting point for you to get a sense of what the market is about and how it's going to be like in the near-term future, or at least help you form the basis of your foundation for your opinions. I hope that answers your question, actually.
Okay, thank you. The next question is, do you expect rise in demand for oil and gas from China in the second half of the year?
Okay, that is actually a tricky question. One of the sticking point this day, I wouldn't call it a blessing per se. Now, China, as you know, facing some lockdown issues, obviously, and one of the biggest theme this year and somewhat late of last year was that we are looking at slowing demand from China, which traditionally had been a commodity powerhouse, power hogger per se, even. But since the COVID outbreak, okay, and coupled with other issues domestically, what we are seeing right now is a very gradual, not gradual, in some parts actually more drastic than other in terms of production, exports, and whatnot. We're seeing a drastic slowdown in China. So, meaning to say, we're probably not going to see a near-term pickup demand in this space. Okay, not at least until there are more clarity as to their policy of whether they're opening up, whether they're trying to fix current more or less closed economy. Now, when they go to lockdown, for example, there are a lot of impossible obstacles. It's not that the company does not want to sell into China. It's simply next to impossible. Okay, so until that policy clarity is out for everyone to see, I think it's hard to call. Or in my personal opinion, I would think even if it does go to the point, it will be gradual, and it probably will be some time before they sort out the domestic issue and for their demand increase to make a meaningful impact on the demand side of the equation.
All right, thank you for your answer. The next question is, with reference to the Heiken Ashi candles, would it be possible to run the strategy in an algorithm?
Yes, definitely it's possible. I mean, I do it myself. Okay, the reason I'm just doing it for illustration purpose in this presentation is actually to run you through basically using some very simple rules. And like I said, this is hardly the perfect system. It works as far as I'm concerned. It works. Okay, so it is up to you to what degree you want to automate it, like setting alarm, setting automation. Alarm on TradingView, for example, is one possible way you can do it, or whichever system that you're using if it allows for it. And like I said, feel free to experiment on it. Feel free to refine it. Automation is definitely possible depending on the platform you use. That will decide the degree of difficulty or complexity of the implementation. But otherwise, that's how I'm doing it as well. I mean, I have to, like, for example, watch like a dozen or half dozen markets. So I wouldn't have the luxury of actually watching it bar by bar for every crossover for every market that I am actually covering. Okay, and that would actually be the more efficient way of doing your trading actually.
All right, thank you for your answer. I think this is our last question of the day. Is there a COT report for LNG available?
A commitment of trade reports. I believe there is actually. I haven't personally read it into it too much. Usually they are showing the more significant one, which will typically be in the index flavor, the treasury, or the forex flavor. Don't take my word for it. I believe there is, although I haven't really, like I said, look at it myself. Okay, but you can take a look at it on the CME website. It's very friendly, user friendly, and very easy to navigate. Just take a look at that and see if you can get a sense of what you are looking for.
Great, thank you, Michael. We do not have any more questions from the floor, so we can conclude the session here. Is
Okay.
If there's anything you want to share?
No. I thank you guys very much for the time you take to join us tonight. And if there's anything else, basically I have this one last slide here with my name and contact. So if you have any question that you can think about, or if you want to contact me about other things or possible collaboration, just drop me a line or something. Yeah.
Great, thanks, Michael. And we will be sending everyone a link to today's recording, so you can watch it again if you would like to. And if you have any questions for Michael, you can contact him, or you can send them to us via the survey that will appear when the webinar ends. And for more information, you can visit our website at swipnova.com.sg. And that's all for tonight. Thank you, everyone. Thank you, Michael. And goodbye.
Thank you, everyone. Good night.